You're listening to This Week in E-commerce, the Ecom Nation podcast. Dive into the top online retail headlines with your hosts, Paul Waddy and Mal Chia. Let's load up the cart. This Week in E-commerce, episode 52. I am Mal Chia, and with me is Paul Waddy. Paul, welcome back.
Welcome back. Thank you, Matt. Happy birthday. 52 episodes. That's a year. We did it.
We did. They said we couldn't do it, but here we are.
And here we are.
Proving them wrong. Yeah, we can stick it out and do a year's worth of podcast, and hopefully many more years worth of podcast, because I think people kind of like what we talk about. Is the feedback I get.
Yeah, it's funny. Like you made the point off air. Like just when you think there's nothing happening, you read it, and you're like, oh man, there's big news every week. And I guess unfortunately some of it's not great lately, but we've got a mix of good and bad today. So it's there's some fantastic results for some companies, and then a couple of behemoths who are reporting some bad news. So another really interesting week in e-commerce.
Yeah, absolutely. And look, it's earnings season, which is one of my favorite times, because you can really get under the hood of like all the big companies, like obviously all the publicly listed companies, which kind of reflects what's also happening in the private sector. But when you have the publicly disclosed numbers, you can really dig into that. And I guess the one which kind of caught a lot of us this week was Webster. Webster have had some extraordinary numbers this past year. So this past quarter, I should say, with record sales. So their revenue for the last 12 months finished at $498 million, which is up 26% compared to the previous year, which is just remarkable to achieve that level of growth, and also with a 31% increase in new customers, of active customers as well.
Man, this is incredible. Hats off to those guys. That is $500 million. I feel like it was only yesterday that they kind of just started. Man, good on them. And the profit is there as well. Even though technically it says net profit fell from 8 million to 1.8, but that's because they wrote down an investment in a startup, or Renovai, but the EBITDA was a very, very healthy 13 million. So profitable and making $500 million in a tough market. Man, I hats off to them. They bucked the trend.
Why do you think they've been able to buck that trend? Obviously, cost of living crisis, like everyone is slowing down spending in different areas, but apparently homewares, furnishings, people are still spending, particularly buying from Temple and Webster.
Yeah, I think you sort of read between the lines. Well, they haven't disclosed much, have they, in the article we're reading from Inside Retail here? But they have 1.1 million active customers. That's a 31% increase. So they've obviously gone on an acquisition drive with huge growth of new customers in a tough market. It just says they managed to buck cost of living pressures. I don't know, Mal. I was trying to look at their net profit margin to see if they've taken a hit on the net profit margin to invest in that acquisition. Like, they're still profitable. It was previously 8 million, now 13. So I wonder, did they just carve out another 5% or something for acquisition? Whatever they did, they did it well, because that's good, bloody good results.
One thing which I have noticed from them in the last 6 months especially is that they are focusing more on branding and more upper funnel marketing. So in particular, through the Olympics, they were advertising very, very heavily on TV. So on Channel 9 through the Olympics broadcast, I saw a lot of Temple and Webster advertising, but also in the 6 months prior to that as well, I also saw quite a lot of advertising on other channels. So not just the bottom of the funnel Google ads, but really investing into building brand, which is, look, as a marketer, I want to say that I would like to think that had a big part to do with it. Just becoming that default place which you think to when you think, okay, I want to buy more furniture. I need a new dining table. I need a new, bedside table. Where I'm going to go? I'm going to go to Temple Webster, and that's part of that transition which brands need to make away from just focusing on product to actually becoming a brand and a destination which people want to go to buy from. And I think that's what we're seeing in Temple & Webster.
I think the CEO agrees with you there. He did say strategic moats around range, and second point he makes, being a top of mind brand. And I'd have to say that what you've said there is correct. Like 30%, 31% increase in new customers indicates they've had a pretty fair old crack at the top of the funnel, and it's paying dividends.
Yeah.
And I agree. Like they are, I know, like they do stand out as a cool brand. Like they are a brand that looks like they've done a great job on their brand. They are a brand. They're not just a seller. They're not just a marketplace. I genuinely believe they're a strong brand. Be interesting to know whether there's much growth coming from their marketplace or their own brands or what. But yeah, I think I agree. They've done a great job on the branding, and they've also take note that they have very low fixed costs, and they're using data and AI to its full capability as much as they can. So yeah, I think that's a good, simple approach that's paying off.
Yeah, look, and I know that Carla Pencan pointed out on LinkedIn a couple of days ago that comparing 2019 to 2024, that their cost per acquisition has gone up and it's actually doubled over that time. And she pointed that out as a bit of a weakness. However, I look at that going, we're comparing very different periods in time as well, that everyone's CAC was relatively low pre-COVID. But then through COVID, it got more expensive as the market got more and more competitive. The cost of media went up. And obviously, we're now in a cost of living crisis as well. So yes, naturally, it's gone up. So for me, when she mentioned that, I thought about that and went, okay, is that something which is a real cause for concern? It's still relatively low. Like given what their basket size is, they have a CAC of about $80, I believe, which isn't too bad if you can turn them into repeat customers. But they're also quite profitable as well.
What's their average order value?
It didn't actually disclose what the average order value is.
But it would be. You'd have to think like furniture. A lot of furniture. You'd have to think it's in the multiple hundreds, right?
Yes.
Yeah. So agree. It's all relative, right? $80 is not high, really. You know, like let's say it's $500 AOV, and I'm going to imagine they do a pretty good job at service. I'm going to imagine their LTV is probably pretty decent. So your CAC is irrelevant until we know the AOV or the LTV. But I don't think even just on face value that $80 sounds horrible at all. I think that sounds rather efficient. I'm going to imagine their AOVs at least 300-400. I'm guessing. I have no idea, but I feel like that'd be at least 300 or 400, which makes me feel like the CAC's good.
Yeah, look, given our experience with other with other brands in similar categories, I would imagine it's over in at least the 200-300 mark. Somewhere in that range at a minimum. Yes, they sell a bunch of other goods as well, but it's still, I would still not be too worried about the CAC. You do obviously want to maintain it and not let it get out of control, but $80 isn't too bad.
No, I think it's fine, and you've got to balance that. They're a publicly listed company. There's enormous expectations to keep growing. So the fact that they're profitable and growing, I think they're doing a great job. Their shareholders just constantly want to see growth, and that's what drives that. So it's a little bit different to your private business. They need to keep growing to excite shareholders. That can be mum and dad investors who just see growth, invest, share price goes up. So slightly different focus for publicly listed companies.
And it's an interesting one about being publicly listed because you do have that pressure to continue to grow. So you end up growing at all costs. And sometimes that can actually change things for the worse because you start chasing growth over actually focusing on delivering quality because you're trying to deliver for your shareholders. But that's probably a discussion for another time because the other stock, which has performed extraordinarily well, is one of our favorites. And I bought from there the other day when I was at the airport, JB Hi-Fi. JB Hi-Fi has hit yet another all-time high. And this stock just keeps climbing every week. And they are just continuing to defy expectations. They were up 6.5% after their earnings report, which was actually delivered lower sales, so 0.4% sales decrease in sales, but also a 16.4% decrease in net profit as well. But the reason why is that they beat the market because every other retail stock was down even more than that.
That's so interesting. We love JB Hi-Fi. I ordered some stuff off them on Wednesday. I only buy it because I can get it delivered in 2 hours. And they're always on time. They're always good. I love them. So you got to think these guys are under threat from your Amazons and so on, particularly on the more generic, keyboards and stuff like that. I think they're holding off remarkably well. What struck me years ago, or like 5 years ago now, when I had a chat with the CEO at the time, he's moved on now, I think, but they were running their business on operating expenses of 7%. So you sort of wonder, like, how can these guys price match and still make money? Well, because they're running their business on 7%. So an incredibly lean business, JB Hi-Fi.
Well, the store's really just like, it's a big concrete building with some
With
racks.
with some racks and some surfers and skaters that serve you.
Yeah.
But
Look, it's a great business. It's a great business. It's and a great omni-channel business. I think their online presence is quite remarkable for the reasons you said before, but also the store presence. Like they are in all the places where they should be. Like they're in, big retail malls, but then they're also at the airport. The airport, they dominate the airports. They are now in every single airport, and you can't help but walk past them. And I've either lost AirPods, I've lost cables, I've forgotten something, I need to buy a charger, and they're right there for me.
And really slick online, really good e-commerce experience. They sort of that endless aisle, so they'll dispatch from stores, which saves on warehousing costs. Thinking back to COVID, when stores were shut, they would get their store staff to deliver parcels. Like they hustle, man. They're clever. Those guys have always been clever, and I just think they're one of the best.
Yep. Couldn't agree more. And speaking of one of the best CRM email platforms out there, Klaviyo, they went public roughly about a year ago. I think September last year they went public, and the shares at the start took a bit of a hit. So they went from their launch price, opening price of $30, and quickly took a tumble to around, I think, the $26 mark. But they are now back cruising at well over $30 off the back of a super strong last quarter's earnings, where they are now viewed as one of the stocks to watch.
This is good news, Mal, because I remember we were both really bullish on this and really backing it, and wanted it to do so well. And it dropped a little bit, which we were kind of surprised at, but it's back. It's back, baby, and it's looking really strong. I think it's as you said, 31, 32. It'll go hopefully back past that IPO price of whatever it was, 35.
30.
And
yeah. No,
30.
it opened at 30. Right. So it opened at 30. So now it's at a high now, and the analysts are saying that it actually should be at 34.88. So it's still got another 20% or so to go.
Well, and big shout out to the local contingent, the local Klaviyo team in Australia who do a great job. Love this. Good story. Good guys. Happy for this one.
Yeah, look, I think you can see that their earnings were expected to be. They landed about $918 million for the first half of the year, which is a fantastic result. And look, I look at this and go, like, it's off the back of there was concerns about their ability to continue to scale past just Shopify, and that if they were only connected to Shopify, how much could they continue to grow? But they clearly have. There's clearly demand for what they're offering. I think they're doing a great job in terms of integrating with other platforms as well, whether it be Magento, BigCommerce, or even WooCommerce, but also just the ability to actually scale into other products as well. So they've done a good job with some of the products they've released, such as Advanced Analytics, the CDP product. And really growing that enterprise side of the market too, because I speak with some enterprises, like not many, but a lot of those enterprises are now starting to think, okay, well, maybe we need to give Klaviyo a look, because they're known as the best of breed in that space. And particularly as you see some of those other products, like whether it be, Salesforce Marketing Cloud or which get consumed by the big tech companies and they become just like corporate products, they become very monolithic in structure. And I think there's a nimbleness to Klaviyo, which I think is very appealing to the bigger end of town and becoming more appealing to the bigger end of town. So I suspect that they're going to continue to grow as they add more to the product, and as they expand their offering also slowly beyond just e-commerce as well.
Yeah, I think they've got this sewn up. You got retailers doing $1 million a year using them, and as you say, you're starting to see enterprise businesses, um, changing to Klaviyo and generally saving a ton of money along the journey as well. So, I mean, yeah, I reckon they've done a good job here, plugging in a few more services, as you say. It'd be interesting to see where they go next, helping brands probably, as we've talked about before, consolidating their tech stack. But I mean, Klaviyo seem to have particularly the CRM side of e-commerce largely sewn up.
Mm. Well done to the Klaviyo team there, especially the local team who we know quite well. So Loz, Susie, Jeremy, Mitch, etc. Well done, guys. Now, moving on to less positive news, and this is a pretty big story, which actually broke a couple of weeks ago. And it was one which I've read this article probably about 3-4 times just to really digest it and understand the meaning of it for other brands in our space. And it's about Nike, which is a brand which we talk about a little bit here and there. And obviously one of my favorite brands, one of your favorite brands, and it's done incredibly well for about 4 or 5 decades now. They wiped out $25 billion of market cap in a single day. you can't help but just like laugh at this and go like, how do you lose that much value? And it's actually $70 billion over 9 months. That's just like a phenomenal erosion of shareholder value in such a short period of time. And it's off the back of their absolutely terrible earnings. And this is like their lowest share price they've seen since 2018. Yeah, and this is after we've had like a pretty considerable bull market, for the last several years. So it's crashed quite a bit. And a lot of this is that their earnings have just gone backwards. Like they as a brand, they just seem to be a little bit lost.
Lost is the right word. How do you think their CEO's feeling? He's been there for a few years, I think. He's got to be under all sorts of pressure. This has been disastrous. We looked at this about 6 months ago and we talked about the fact that they started trying to get into D2C, and clearly that's happened at the expense of their wholesale business. And so what's also interesting is that they are desperate. They re-released, Nike do great partnerships. They did the Tiffany's one last year, the Air Force one with Tiffany, the blue color, beautiful. And then these sneakers, this one particular one, and I can't think of which one it is, but anyway, it sold out. It was a collab with one of the American rappers or whatever, and it was reselling for 11 grand, Mal. 11 grand resale, and they reintroduced it as core. So they went, we've decided that it's not limited edition anymore. We need the money from that. We're going to sell it. And it's like, oh man, when you start to play with the resale market of Nike, particularly on the collabs, in many respects, the resale market sets the benchmark for what people are prepared to pay. And when you start pissing off the resellers and the shoe lovers, that's a cult, man, that's playing with fire. I was like gobsmacked. Like, you can't do that. You can't release those shoes again. That's not what you do. That's desperate. And man, this guy, D2C hasn't worked. Wholesale's broken relationships with wholesalers. This guy is not going well, Mal.
No, and John Donahoe, who has, like I said, been the CEO for quite a few years now. So he became CEO in 2019. His background, though, is interesting in that he doesn't actually have a retail background. So he was the president at Bain & Company, where he was for 20 years. Then he was at ServiceNow as CEO, and then also was CEO at eBay, I believe. So he's come from, not eBay, so ServiceNow. So he wasn't the CEO of eBay. So I'm going to retract that part. But he's come from a background where he hasn't actually had to work in retail before or anything to do with branding. And what was interesting to me is that the decisions which Nike made were informed by McKinsey. So they worked with McKinsey, so one of the big consulting firms who do what consulting firms do and just talk about efficiency. We need to do efficiency and we need to maximize profits. And we're going to do that by focusing on our high margin channels and get efficiency throughout the rest of the organization. So the two biggest things they did was that they, like I said, they decided to scrap the wholesale market and just go D2C, go primarily D2C and really restrict what wholesalers could get access to. And then on the internally as well, Nike used to be organized into different divisions based on the different categories. So there was a basketball division, there was there was a tennis division, there was a running division. But what they changed was that they changed that to just having like men's, women's, and kids and accessories. And then they consolidated all the groups. So they just had product groups, marketing groups, all working across multiple divisions, across multiple sports and multiple categories. And what the author of the this LinkedIn article has written, and he used to actually be the CMO at Nike, was that by doing that, they lost all that expert knowledge in each one of those verticals. So where Nike used to dominate running, whether it be Pegasus, Vaporfly, they used to dominate basketball, they used to dominate all these different sports. Suddenly by consolidating them, they lost that ability to really specialize and own that. And then the last few years, you can see that particularly in the running space, the rise of all these other niche running players who've kind of noticed that there was a gap there and started to fill that gap, whether it be a Hoka or an On who just focus purely on running and have just now eaten up all that market share, which Nike has left on the table because they decided to go to a D2C route.
That's so interesting because even thinking as a kid, the way you used to shop in Rebel or whatever, you'd go to the Nike section and it was split out by occasion, and that would actually guide you on what you would purchase. And it's consolidating it. You're 100% right. It has opened up some of these niche brands to come in and just go, yank, I'll take that running market. Like you really see runners wearing those brands that you just mentioned.
Yeah, Hoka On, like they're growing. Yeah, Hoka is everywhere now.
And that's interesting because like there's probably not long ago where you were like, oh, nobody can get into that space. It's Nike, it's, Adidas and whatever, Mizuno on the fringe and stuff. But these guys have just come in and gone bang. And I wonder if I wonder if this is going to see the rise of any new entrants that come into athletic sneakers. I'd love to see that, like some streetwear. That would be super cool. And you are also starting to see fashion brands do collabs with like ASICS have done some cool collabs with Earls in Australia. New Balance have done some really cool stuff with fashion brands. So, man, some of these other brands are doing really cool stuff, and Nike's just lost their way a little bit, it seems.
Yeah, because Nike used to dominate. Like any footwear retailer who you spoke to, and if you ask them which brand made up the majority of the sales, they would say Nike. But over the last few years, that has changed quite a lot, again, with the rise of all these different niche players. And part of it as well is that when Nike went down that D2C route, is that they pivoted a lot of their marketing as well away from brand marketing. Like Nike were the kings of like brand marketing, experience marketing. Yeah. You would go to any stadium in America and there'd be like Nike everywhere. They sponsored all the biggest teams would wear Nike, all the biggest athletes would wear Nike, and they'd create these amazing brand campaigns. Whether you're talking about Michael Jordan back in the 80s and 90s, or whether you're talking about the Serena campaigns, or more recently the Colin Kaepernick campaign during COVID. They were great brand campaigns. But now they seem to do less of that because they shifted a lot of their focus towards more performance-based marketing. Again, at the advice of McKinsey, who recommended that they focus on selling more through their Nike Direct channel, which meant that they were, instead of just focusing on building the brand, they started focusing on discounting and promotions, ways to bring people to the online store or to the app to sell directly to them, and stop doing as much brand marketing as before. And part of that was that, and the article says that, they went from playing offense to then actually starting playing defense, because rather than trying to push the brand and going, let's grow the brand, let's make sure Nike's everywhere, they started going, hey, wait, come to us, like choose us over someone else. Don't buy from one of our wholesalers, come buy from us. Don't buy one of our competitors, buy from us the 10% off or whatever. And there was such a big change. And they actually said this about a year ago, where they made a big reshuffle in the marketing organization, where they actually said, you know what, we've gone away from brand marketing. We need to get back to more brand marketing. But I think the damage was already done by that stage. And we're seeing that now from this earnings report, where all that trust they'd built with their customers and also their wholesalers has now been lost.
Couldn't agree more. I, even as a consumer, I noticed a shift a year or so ago when I'd always buy Nikes from elsewhere. Then I started checking out their site and I was like, these guys are cheaper. They were. You could get a discount. You could get something like their pricing, and was like, wow, this is going to piss off a few of their wholesale customers. I just think that it's funny. Like they pivoted to D2C to chase the higher margins. Yep, that makes sense. In theory, but now we've seen in the article, it's actually eroded their margins, their gross margins. So reading between the lines, what is that? That's probably discounting to acquire customers, and then spending way too much on or inefficiently on performance media. So it turns out it wasn't as profitable or quick on the uptake as they thought. I just don't know how they bounce back. I mean, yes, sure, they're still going to sell millions and billions of sneakers, but have they lost the edge? I'm not sure. Like, are they going to lose that edge if the cool stores stop selling them? Which is particularly in the US, the resellers, that's a big thing there. The cool stores stop selling them. The cool athletes start pivoting to other, Under Armours and so on. Could they actually lose their edge, which is like unthinkable? But could it happen?
Look, everything happens in cycles, right? So they can't be number one forever, and they have been more or less number one for the last 40 years. So it wouldn't surprise me if this starts if this is like the beginning of the undoing of Nike to become more of like a middle tier brand. But at the same time, they also are so bloody big. Like, even despite all the headwinds, they still are, by a fairly large margin, the largest sporting goods company in the world. So they're not going to go broke overnight. And I think that they can put a lot of things in place. But I guess, first of all, they need to shift that focus. I think they need to shift that focus back towards building the brand and being part of the sport from the grassroots up, which is what they were. Like, their tagline was like, we believe everybody is an athlete. So everybody. So getting back to that of like, hey, we're actually, we will support everyone in their athletic pursuits, regardless of sport. So then they can go back to specializing in those verticals. I think it's going to be really important. And then to make sure they can build those wholesale ratios. Because one thing which has really struck to me is that the belief was that people won't go to their Rebel or and buy the Nike if they can't get it there. They'll just go buy it online. But what happened was that they went, oh, I can't get it here. I'll just go buy something else. So even that whole idea about brand loyalty, like a brand as strong as Nike, how loyal will people be if your product isn't actually available to them?
So are you about to go out and trade in your Jordans for a pair of Slazengers, Mel?
No, I am not. I actually bought another pair of Jordans the other day.
Did you?
I did. I'll wear them to Sydney next time.
Okay.
I got some white mid tops.
Nice. Okay. Yeah, we still like Nike, but I think, man, this guy's got it wrong, basically.
Yes, I think the old saying, just like you measure what matters, but also not everything that matters can be measured. And I think this is where they went wrong, because they looked at the hard numbers, and the hard numbers did support that. The hard numbers would obviously support the fact that, yes, you get higher margins by going D2C.
Yeah.
But that doesn't really matter if you have to discount 20% to get the sale.
Yeah, I think that's a good point to wrap that on, because we talk about that with much smaller brands than Nike, and it just goes to show it can happen to we've seen heaps of examples over these last 52 episodes of big companies who get it wrong as well. And I think in this instance, it's a lesson learned. Discounting is not the answer, and their margins have been hit, and they've wiped huge value off their business. So, tough one to swallow.
Yeah, I think the big lesson for the brands who are listening to us today is really that you need to focus on building your brand. If all you do is focus just on product-led marketing and just focus on just performance-based marketing, you are going to lose, because you're going to end up in a rat race and competing against everyone else who has a similar product to you. And you see that again we talk about Temu now almost every week, but you see that with Temu. If you are competing in a category which Temu is also in, well, you're going to lose, because they will price lower than you, and you'll never be able to compete with them. So unless you have a more desirable brand, which people actually want. And I used the example today when I spoke about attracting the right customer for your Ecom 100 workshop, was about the fact that Aesop sells hand wash. Yes, it's very lovely hand wash, and they sold to LVMH for $1 billion. LVMH weren't buying hand wash. They were buying the brand. They were buying the prestige around someone who would want to pay $60 for Aesop hand wash.
Yeah. buying the brand is a good way to put it, Mal, because we say it often. What separates this T-shirt from, probably one out of the same factory in China that might be $30 cheaper is the brand that sits on the chest. Same as your hoodie there. It's the brand that people are buying into and not always the product.
Absolutely. All right. And speaking of brand, we are going to wrap it up here and also wish one of our favorite brand people, TK, happy birthday. You're probably not listening to this. I don't think TK listens to this. I don't think he listens to many podcasts. But TK, happy birthday, mate.
TK, happy 41st. If you listen, no, he's not 41.
Oh God, he's not 40.
No, he's much younger than that. But TK, GM of G'd Up, big happy birthday, mate.
Paul, it's been a pleasure. Great to have you back on for our 1 year anniversary.
Yeah, we should have started with a little cake.
We should have. But then I only released the audio version, so no one will see it. But yeah, we can do that next time. We'll make sure next time we will get a photo of us with a cake in Sydney when I'm up there in a couple of weeks' time.
Lock it in.
Fantastic. All right. Thanks everyone for listening. Thanks for being with us for 52 episodes. We'll be back next week.